Alright guys, so one of my many hobbies as I've matured into a man over the years is finance and stocks and stuff like that. So I don't know whether you guys are familiar with the topic, but if you clicked on the video, it's probably because you want to learn some basics about options and option trading. And honestly, I just woke up this morning and realized that I do have a lot of knowledge on this topic, and it would be a shame not to flesh it out into a video that could potentially make you guys some money. So to start off, I'm just going to explain briefly what an option is. It's basically an agreement between a buyer and a seller to exchange shares of a company for money on a certain date. And there's a lot more intricacies that go into it, but that is the basics of it. Basically, the point of doing this is that you don't have to buy a huge amount of shares to achieve a similar result. You can just buy the one contract, which is usually much cheaper than how many shares of that company you would have to buy to get the same amount of profit potential. And yeah, so with that being said, we're going to jump over to the computer and I'm going to show you guys the finer details. Alright guys, so to keep a long story short, we're going to jump over to Robinhood on the desktop computer. I personally usually use Robinhood, even though they've been the perpetrator of a few strange activities such as the Dogecoin scandal that happened last year. I think that overall Robinhood is the most easy to use and is pretty trustworthy compared to other networks. But if you guys want to use Webull, you can, or whatever other platform that you want to use. Options trading works the same regardless. But here we have pulled up Apple stock. Actually, I'm going to switch over to just raw Apple stock for a second. So as you can see here, Apple is at the price of $173 right now. You can see on the week it's up 3%, on the month it's up 14%. So overall, it's been climbing a decent amount. So the way I would look at this is a general uptrend in Apple computers, and I would say that this trend is overall good for the future of Apple, especially in the short term. With a stock like Apple, you would expect it to do well, but there have been several times, like right here from March 28th all the way down to June 16th, where it just went down for 3 months straight. So that would be a good time for a put. Yeah, so I just wanted to show you guys like the logistics of what's going on with the stock that we're going to be talking about. And basically all you want to do is, instead of buying like stock, so you can of course buy stock, you can buy in shares and then buy a million shares, however many you want. But you want to go down here and trade Apple options. So this will bring up an entirely different screen that we're going to go over right now. So basically what's happening here is these are a list of contracts that you can purchase in order to profit off of these options or lose money depending on how smart you play the situation. But the most important thing is the expiration date. This is something that you need to know about options. The closer your expiration date is, the more risky of a play it is, because as you get closer to the expiration date of an option, it expires, so you lose money just because of the fact that you're holding that option. Options are not meant to be held. Most options end up expiring and worthless, so definitely watch out for that, because that can happen to anyone if you're not paying close attention. So unless you're super confident in the play that you're making, you usually want to go, I would say, at least a month out. So I'm going to go for the expiration date of September 9th. So basically, as you see here, we're going to go right to the middle. So this is the share price right now, $172.91. So I'm just going to go through what a call is and what a put is and explain the situation for both. Okay, so if you want to buy a call for Apple computers, you basically just pick your expiration date and then you click on one of these contracts here. So right here you have a contract for $175 strike price. And as you can see, the break even for this contract is $177.99. I think this is the most crucial thing to understand about options, whether you're doing calls, puts, buying, or selling. Basically, what this number is, this 177.98, that is the price that you need Apple to be at in order for you to break even on September the 9th. That's not the price that you need it to be at to break even in general. When you buy the option, you pretty much break even at the strike price. So right away you're losing money just by buying the option call. That is one downside of options. But if you are confident enough, then you will be able to do it correctly. So let's say you want a long Apple for the 9th of September with a strike price of this. And obviously these things all fluctuate depending on the price of Apple right now. So let's say Apple tanked down to 171 in the next hour for whatever reason. That would make this call less expensive because it's less likely to happen since you're already at more of a deficit going in. So here's the $175 call, and the total cost is $3.05, which basically, when you buy a option contract, you automatically get the right to buy 10 shares of a company. So $3.05 is really $305, which is the exact amount that it'll cost. You can just review the order and you're pretty much guaranteed to get it because this is not a very far out option. So if you wanted one of these other ones, they might take a while to fill because not many people are selling those options. So once you buy the option, I'm not going to do it right this second, but it's very self-explanatory. You just review the order. Once you own the rights to this contract, you have two options. You can either wait for Apple to go up sometime within that time frame between today, August 16th, and September 9th in this particular case, and then you can sell that contract when you make a profit. Like I said, it doesn't need to be at that break-even point if you're not at the date when it expires. So if Apple went to 176 right now, you'd be in good hands. You can sell your contract. That'll be it. Self-explanatory, one and done, quick and easy. The other thing that you can do is you can execute the rights to the option, and you can buy those 10 shares at a price of 175 when the stock is already at 178 or whatever it might be in the not so distant future. So if you're really confident in the longevity of the option, you can do this, and it'll probably be cheaper than going out and buying those 10 shares right off the bat because you can actually plan for this and you'll already be in a profit right when you click that buy button. I would strongly suggest not doing this with a company like Apple because Apple has been very volatile lately unless you're holding for the long term, which obviously is a very good strategy, especially with these blue chip companies. Then yes, you can do that. But otherwise, if you're trading, I would suggest selling your option at a profit. And one more thing that I want to note quickly is that the reason why this break even is higher than the strike price at the expiration date is because the way that you calculate the break even is you take the strike price and you add the amount that it costs to buy the option, and that's how you get this. So 175 plus $3.05 is roughly around 178.05 to be exact, but it's a little off right now. So if you want to buy a put for Apple, it's the same exact thing. So let's say the share price is 173. you want to buy a put for 170, you're extremely bearish on Apple. Basically, it's the same exact thing except in reverse. The way you get the break even for the expiration date is you take the strike price and you subtract the amount that you are paying for the option. So in this case, it's $2.68. 170 minus $2.68 is right around 167.35, and that's how you get that. So this is only if you are bearish on Apple and you think it's going down. If you don't know what bearish means, basically in the short term you think it's going down. Bullish means in the short term you think it's going up. So yeah, and basically this is going to be a little bit cheaper right now because Apple is overall on an uptrend. So shorting it is riskier, therefore cheaper. That's how it works. With that being said, I'm not going to put you guys through much else because that is a lot of info for one day. I'm not even going to talk about selling calls and puts right now because that is much more complicated. What you have to know about options is that they're very risky. Obviously, this is not financial advice. I'm not telling you guys to go do anything, but do it at your own disclosure. With that being said, thank you for watching. If you guys want more videos like this, maybe one about selling calls and puts, I will make them if they're doing good because I do like this topic. So thank you so much for watching. Take care, and I'll see you all soon.